Hello friends, welcome to my channel. In today's video, we are going to discuss the case study of a agri-science company called Rallis India Limited. If you haven't subscribed to my channel, please do subscribe right now and hit the bell icon. Join my Telegram channel for a lot of stock specific views and discussions. So why we have chosen Rallis India? Because in the poll in the YouTube community, majority of the people, 33% of the people have chosen Rallis India to be analyzed. I am Varun Agarwal and let's get started. So Rallis India is a Tata Group company. It is a subsidiary of Tata Chemicals. This company is into farm essentials, which is crop nutrition and also seeds manufacturing. It is India's one of the leading crop care companies, and it has a wide distribution network of 2,300 distributors, 40,000 plus retail counters. It has a very wide reach, reaching almost more than 80% of districts in India, which is a very good presence. It has a great understanding of the Indian agricultural market, and it has a wide portfolio of products which suits the Indian agricultural market like fertilizers, pesticides and various other products. So coming to the management, Mr. Bhaskar Bhatt is the chairman of the company. He has been associated with the Tata Group for a long period of time. He is a postgraduate diploma from IIM Ahmedabad. He is the former managing director of Titan. Coming to the managing director, Mr. Sanjeev Lal, he is also associated with the Tata Group for a long time now. In the last 20, in his career, he has worked for Hindustan Unilever for 21 years. He is a BTech from IIT Delhi and he is a past Chief Operating Officer of Tata Chemicals. So you see that the people who are managing the company in the top management are very experienced people and very loyal to the group. Now let us understand the business model of Rallis India. Broadly, this company has two divisions. One is crop care and seeds. 84% of the revenue comes from crop care and 16% of the revenue comes from the seeds division. Under crop care, again they have crop protection and crop nutrition. Crop protection is for making fertilizers, pesticides and other things which give the protection to the crop which is already growing. Crop nutrition is to give better yield to the crops like manure and other chemicals which are used by the farmers. If you see the distribution network, the crop care network has 3,812 dealers, 47,377 retailers, and the seeds division has about 2,600 dealers and reaches more than 40,000 retailers. This company exports to more than 70 countries globally and it has more than 1,600 employees working for it. So you see that the distribution network is very strong. If you see the manufacturing facilities, they are mainly located in Maharashtra and Gujarat, and they have innovation centers located in Bangalore. Let us understand the market and the industry in which this company operates. This company operates in the agri-science sector. So this is directly related to the food demand, and as you know, as the population is increasing, the food demand in our country is growing day by day. As the urbanization takes place, less and less land is available for agriculture. So the farmers need to generate more and more yield from the lesser land. So they need to buy more of nutrients and other things for the crops to give better yield, and they have to protect their crops for giving better production. So that is why this sector is growing and booming day by day. Indian seed market is expected to grow at a CAGR of 14.2%. India is the second largest consumer of fertilizers globally. The fertilizers market is growing at a CAGR of about 12.2% and the crop protection market is growing at a CAGR of 4.7%. So there is a steady increase in the CAGR, the growth of these particular sectors which are connected to this company. Now who are the competitors of this company? PI Industries, Bayer Crop Science, Bharat Rasayan, Dhanuka Agritech, Insecticides India. These are the major competitors in terms of listed companies in India for Rallis India. What is the moat, economic moat or the competitive strength which Rallis has when compared to its competing companies? Rallis had a lot of brand advantages. Over a period of time, they have developed a lot of brands in the products which they sell. One of that brand is called Dhanya. And the Tata Group as such has a lot of good name in the country internationally also, which gives this company a lot of advantage while marketing its products. This company has very strong, well diversified manufacturing facilities, and they invest every year in research and development and developing new products. This company has also exports, as we have discussed, in 70 plus countries, and the distribution network is very wide, covering more than 80% of the districts in India. The product portfolio, they are increasing and growing and making it wide every year. So due to these trends, a new company competing and entering into this sector with Rallis India is very difficult. Now, what are the growth prospects in the near future of this company? India is moving towards self-sufficiency. We are trying to reduce the imports in everything possible. And in terms of food also, we are trying to manufacture or grow everything in India. So that is a good sign for Rallis. India is becoming an important player in export of food products. They are trying to engage more and more in exports. There is a gap in adoption of agricultural technologies. In other countries, there are highly equipped equipments and other technologies used in agriculture, whereas in India it is still less developed. So going further, more and more developed chemicals, pesticides and other technologies and equipments are bound to be used in India, which is a good sign for Rallis. Rallis aspires to be among the top 3 companies in its sector in India by 2025. It is investing in research and development every year for its growth. It is enhancing its production capacities. It is enhancing the value which it offers to its existing and future customers. And it is also adopting new technologies, like it has implemented SAP, it has implemented Salesforce automation, dealer management, HR automation and several other things in this particular year. Now specifically, what is the growth strategy for crop care segment? The demand generation through the brand image is growing because the brand is set in the market. Geographically, they are expanding to other areas, India and internationally. They are expanding their product portfolio. They are adopting emerging new trade channels and they are increasing their capacities of crop care segment. Internationally, if you see, they are getting into countries and further expanding in America, Europe, Africa and Asia Pacific. And they are also doing a lot of contract manufacturing for other companies and focusing on increasing the sales of contract manufacturing in the crop segment also. They are also developing their branded sales business in this particular segment. Now coming to the seeds segment, how are they growing this? They are leveraging their strong position in this segment in Kharif market of paddy, maize and millet. They are speeding up the growth momentum of cotton as a product specifically. Their portfolio, they are continuously updating by adding new and new products and removing the non-moving products. Their existing brand, which is Dhanya, is very well known in the market. They are taking the advantage of that. And they are also finding new and new channels and distribution networks for supplying their products in the seed segment. What are the risks which this company faces? The biggest risk in agriculture related industry, as per me, is the climate. If the climate condition is very bad in a particular year or in particular season, drastically the yield effects and the sales of this company will get affected, which is a very big risk. And surprisingly, if there is a very good season, then it will get a boost also due to the same reason. So there is a risk of climatic changes, there is a risk of competition, there is a risk of macroeconomic changes or policies by the government. The business development is a challenge as they have to deal with the farmers and the other people. They are dependent on their vendors for some very key inputs. They are also dependent on imports for their inputs, and their sales are related to exports. Due to this current COVID situation, there is a problem in the imports and exports slightly, which every company is facing. They are adopting new technologies for managing their entire business. So there is a risk of cyber security also to their business. Now coming to the financial figures, if you see the revenue, it is continuously rising in the last 5 years, and the latest year it is about 2,286 crores. Profit and loss for the period, it is consistently in profit. The 2017 was a very good year for the company. And in financial year 2020, it has done better than the last 2 years and clocked a profit of about 183 crores on a consolidated basis. Long-term borrowings are continuously reducing, so you see that the company's debt are in control and it is a very low debt company. If you see the return on equity, overall in the earlier years it has done better, but in the recent years it has dropped a little. It has come down to about 13.11%, which I feel a return on equity is a little on the lesser side, which is not a good sign. Coming to the latest quarterly result of the June 2020 quarter, the revenue for June 2020 is 662 crores, which is better than June 19 last year of 623 crores. March quarter, just before the current quarter, was a very bad quarter for the company, and there the revenue was 346 crores. So the revenue on quarter basis has been good. Profit in June quarter is 92 crores when compared to the earlier year June it is 68. So it has done much better than the earlier year June quarter. And March, as it was bad, it was 0.68 crores. Now let us talk about the yearly financials. In financial year 2020, the revenue has grown by 20, they have done a revenue of 2239 crores, which is up by 13% when compared to the previous year. The profit is 184 crores, which is 19% better than the previous year. Earning per share is rupees 10, which is 25% more than the previous year, and the inventory turnover ratio is 3.22, which is less. What is inventory turnover ratio? The time taken by them to how fast they are selling their inventory. So if this ratio is less, that means their inventory is not selling very fast. The sales growth average in the last 3 years is about 8.8%, last 5 years is about 3.8. So in terms of sales growth, I feel this company is growing a little slow. The capital expenditure incurred by this company in current year is 79 crores, in the previous year was 47. So they are investing decent amount in the capital expenditure, which is into plant and machinery and other things, which is a good sign. The investment in research and development in the current year is 34 crores compared to 33 crores previous year. So they are consistently investing in research, which is again a good sign. Coming to the crop care segment wise understanding of the growth, revenue in this crop care segment grew by 17% and profit grew by 11%. Revenue grew because of the new launch of fungicides, insecticides, herbicides, the new product launches, and the market reach is increased by adding distributors and retailers. So the crop care segment is growing much faster than the seed segment. The seed segment grew by 8.3%. The seed procurement, the inputs prices increased, which reduced their margins. They have launched new products in the present year to fill the portfolio gaps, and they have minimized the production failures. Now coming to the promoters holding, it is 50.09%, which is slightly on the lower side. FII holding is 4.34%, DII is 24.72%. So if you see that in this particular company, DIIs are showing a lot of interest. Remuneration to directors is 4.23 crores, which is pretty decent. Equity is being consistent, the reserves are growing very fast. The debts are very less, it is almost a zero debt company. The cash flow from operating activities is 337, investing outflow is 246. So this company has positive free cash flows, it is a cash rich company. The current investments of this company has 299 crores and cash is 49 crores. So this I have put here to show that this company has sufficient cash balance and it is a cash rich company. The final dividend in the financial year 2020 declared was 2.5 rupees, which is 250% of the face value of 1. The dividend yield is 0.85%, which is less. So if you want an investor who wants good dividend every year, then this is not the right company to invest. The PBDIT, profit before depreciation, interest and tax margin is about 13%, which is decent. Net profit margin is 8.15, which is again decent for this sector. The return on equity and return on capital employed is 13.11 and 15.5, which I feel is less. They should be performing better and getting ROC and ROE of more than about 20% to become attractive for an investor. The auditors of this company are KPMG, that is BSR and Company LLP, which is a big four company which gives us more confidence. Now coming to the valuations part, the last traded price is about 295 rupees, 52-week high and low is 125 and 324. The last 1 year, the stock has given a return of about 85% and 5 years it has given a return of about 30%. So in the last 1 year, the performance has been very good, but in the last 5 years, the performance is okay, but not that great. The market cap is about 5750 crores, so it is still kind of a small or mid cap company. The P is 27, industry P is 47, the earning per share is 10 rupees and the PB is 4.08. So the intrinsic value as per Graham's formula is about 150 rupees. So in terms of valuation, if I see the growth rate of this company, I feel that this particular stock is overvalued for this point of time of investment. Now coming to the stock levels, pre-COVID in the early March or Feb ending, it was trading around 200 to 230 levels. In March, it took a low of about 150 and took a support of it took a low of about 150. And recent in the last 1 month, it is taking support around 260 for the short term, and around the next support is coming around 200 levels. Coming to the resistance, it is showing some resistance at around 300 levels. So when I see that this company stock is slightly expensive, I feel that if somebody wants to get into it, he should wait for some time and try to enter at around 200 odd levels for this stock. Coming to the recent news and announcement, COVID will have a lot of impact on this company because it is importing raw materials from abroad, and it is also exporting revenue to sales to so many countries. So both import and exports may get impacted if the COVID situation doesn't get solved very soon. Mr. Rakesh Jhunjhunwala has stake in this company, which gives a lot of confidence to investors like you and me, and he has further increased the stake in the June 2020 quarter. So there may be some growth in the company which is upcoming, which may or may not be known to you and me. The construction of a plant at Dahej chemical zone has restarted after the COVID situation. They are expanding the capacity of metribuzin by 500 MTPA, and they have commissioned the plant in July, and they will start production soon. So the recent developments are positive, and they are on the verge of growing further. So this is the overall case study of Rallis India. To conclude, I have given you all the indicators to help you decide and take the right decision about this stock. This sector in which this company is operating is a very positive agricultural sector which suits the Make in India movement and also the food increase in India. The company has shown consistent growth, and it has a very good promoter backing, as it's a Tata Group company. They are investing into technology. The company is almost a debt-free company. The recent one here, this stock has given tremendous returns. Margins are decent, return on equity and capital are slightly on the lower side. Valuations, I feel they have increased recently. Unless the company shows fast growth in the next coming quarters, the valuation will remain expensive as per me. The stock is highly volatile and can be affected drastically due to the climatic conditions in the country and the monsoon. And the companies is depending on the export and imports, which may be impacted for the COVID situation. So these are the plus and minus overall. Based on this, you should be taking the right decision, I feel, whether or not to invest in this stock. So thanks for watching this video. I hope you like it. Subscribe to my channel, hit the bell icon, join me on Telegram, and let us discuss some great news and views. If you want me to make videos on your favorite stock, do leave the name of the stock in the comment below. The most repeated name, I will choose the few names and create a poll, and from that poll you can choose on which stock I will make the next video. Thanks for watching, and have a great day and happy Independence Day.